The IRS doesn't care that your crypto crashed. They don't care that your portfolio is down. They only care about what you did during the year. And most crypto investors are about to find out the hard way. Every coin you swapped, every staking reward you earned, every airdrop you claimed, every DeFi transaction you ran, all of it generated tax events you may not even know about. And the bill is coming, whether you tracked it or not. In the next 12 minutes, I'm walking you through what actually counts as taxable, the difference between short-term and long-term capital gains, the legal strategies investors use to reduce taxes, and the 4 records you have to keep starting today. I'm not a CPA. Nothing here replaces professional advice, but the framework I'm about to give you is what most investors should have learned years ago. Let's get into it. First, Wang, let me be very clear about something. I am not a tax professional. I am not a tax professional. I am not a CPA. Tax laws change every year, vary by state, and depend on your specific situation. Everything in there. This video is educational framework only. Before you make any tax decisions, talk to a licensed tax professional who specializes in crypto. With that established, crure. Let's get into what most YouTubers refuse to explain because it's not exciting. The single biggest misconception in crypto taxes is this: hout. People think they only owe taxes when they cash out to fiat. They don't. The IRS has been clear since 2014 that cryptocurrency is treated as property, not currency, which means every time you dispose of crypto in any way, that's potentially a taxable event. Disposal includes selling for dollars, swapping one coin for another, buying something with crypto, even gifting crypto above certain thresholds. Let me give you the most painful example. You own one Bitcoin worth $100,000. You bought it years ago for $10,000. You decide to swap that Bitcoin into Ethereum because you like Ethereum's outlook. You never converted to dollars. You never sent anything to your bank account. You just swapped one crypto for another. The IRS sees this as you selling Bitcoin at $100,000 and immediately buying Ethereum. You owe capital gains tax on the $90,000 gain apparent. Even though you never touched fiat, this is exactly the trap that destroyed Jay in video 4. Now let's talk about the difference between short-term and long-term capital gains, because the difference is enormous if you hold an asset for less than 1 year before disposing of it. That's a short-term gain, avert, taxed at your ordinary income rate, which can be high. If you hold for more than 1 year, that's a long-term gain plan, taxed at significantly lower rates. The exact percentages depend on your income bracket, and they change yearly, so I won't quote specific numbers. But the principle is universal to life. Holding for over a year saves you a meaningful percentage of your gains, this single rule. The way serious investors think about every trade, if you're sitting on a position that's been profitable for 11 months, the difference between selling now versus waiting 1 more month can be significant. Thousands of dollars in tax savings, that's not gambling, that's planning. Now to freeing. Here's the category most people completely miss. There's a whole class of crypto income that isn't capital gains at rate. It's ordinary income, and it's taxed differently. Usually at higher rates, staking rewards are ordinary income. When you stake ETH and earn additional ETH as a reward, the value of that reward at the moment you receive it is taxable as ordinary income, not later when you sell it, the day it hits your wallet. DeFi yield is ordinary income, the interest. You earn lending stablecoins on OV or compound termed. That's income, taxed in the year you
earn it, regardless of whether you withdraw it. Airdrops are ordinary income. If a project sends
you free tokens, the fair market value at the moment of receipt is taxable income, yes. Even if the tokens were sent to you unrequested, yes. Even if you never claimed them, yes for. Even if they later go to zero, the taxable event happens on receipt at the value at that time. NFT sales follow capital gains rules, but with twists. I won't go into here because they're project specific and the rules are evolving. This is why. Crypto tax tracking is exhausting if you do it manually. You're not just tracking buys and hot drop, each one with a date, an amount, and a USD value at the moment of day sells. You're tracking every airdrop, every staking reward, every yield distribution, every loyalty token, every promotional. Here's the most powerful concept in crypto tax planning: tax loss harvesting. This receipt. A legal strategy used by sophisticated investors. And it works like this. If you have a position that's deeply down, you can sell it at a loss. To realize that loss, the realized loss can offset realized gains from other trades, reducing your overall tax bill. If your losses exceed your gains, you can use them to offset ordinary income up to certain limits and carry forward the rest to future years. Here's the catch in traditional investing. There's a limit. Something called the wash sale rule that prevents you from immediately rebuying the same asset within 30 days after selling at a loss. Historically, crypto was NOT subject to the wash sale. Because the IRS classifies it as property, not securities, this created a unique opportunity. You could sell crypto at a loss, harvest the tax benefit, and immediately rebuy, as of. When I'm recording this in 2026, this loophole exists in some form, but legislation has been. By the time you watch this, the rules may have changed. Always. Verify the current state with a tax professional before relying on this strategy. Now, let me tell you the 4 records you absolutely must keep for every single crypto transaction. Date and price. At the time of the transaction, the exact asset and amount bought or sold is recorded, along with the USD fair market value at the time of the transaction and the counterparty per go, whether that's an exchange name or a wallet address. If your exchange shuts down, if your account gets locked, if the first exchange loses your transaction history, and these things happen, your tax records still need track. To exist, the IRS will not accept the exchange lost my data as an excuse. Records are your responsibility. Keep them in a separate location you control. This is why I stopped doing my crypto taxes manually years ago. The volume of transactions is too high, and the risk of missing something is too costly. I use a dedicated crypto tax software, Abu. There are several reputable options. They connect to your exchanges and wallets through APIs, automatically pull your transaction history, calculate gains and losses, and generate the forms you need. The cost of options. The software is trivial compared to the cost of getting it wrong. If you're serious about crypto, do not do your taxes by hand. Here's how tax awareness actually changes your investment. behavior token. And this is the part most people don't appreciate. When I'm deciding whether to take a profit, I check how long I've held the position. If I'm at month 11, I usually wait. If I'm at month 13, I act. When I'm rebalancing my portfolio, I prioritize selling positions that are at a loss to harvest those losses before selling positions that are at a gain. When I'm doing DeFi yield, I factor in that the yield is being taxed as ordinary income, which lowers the effective return compared to long-term capital gains. Awareness doesn't replace investment strategy, it refines it. And the refinement, over time, is worth a fortune. Significant amount of money. I want to address something some viewers are thinking. Can't I just not report? The answer is no. Major exchanges in the US for Coinbase, Kraken, Gemini, and DAO, others to can, now report user activity to the IRS automatically through 1099 forms. The IRS knows what you bought, sold, and earned through these platforms. Decentralized activity is harder to track, but the legislation is closing those gaps every year. The they won't know strategy is not a strategy. In 2026, it's a delayed audit. The good news, Cam, once you have a system in place, taxes become predictable. They're a known cost, not a surprise. You build them into your plan. Investment planning, you set aside money for them as you go. You consult a CPA every December to review your year-end position and make any final tax optimization moves before December 31. This is what serious investors do. They treat taxes as part of the investment process, not as a separate obligation that ambushes them every April. The platform I use is linked in the HAR and has a section dedicated to tax-aware investment strategy, not tax preparation TANs. They don't do that, but strategy guides written by professionals about how to structure your investments to be tax efficient. Consider holding period optimization, tax loss harvesting playbooks, and state-by-state considerations for you of strategic thinking that compounds across years. If you want that level of insight, check it out. If you'd rather start with the basics, connect to tax software, keep good records. The most important thing is just starting. Don't wait for April. In the final video of Season 2, Color, the next one, Crayon, I'm tying everything together. AI exposure, stablecoin deployment, tax planning, all of it integrated into one comprehensive system. You can adapt to your own situation. This is the video that puts every lesson from Season 2 into a single roadmap. If you've made it this far through the series, that finale is for you. Subscribe and hit the bell so you don't miss it. Drop your biggest crypto tax question in the comments, Fro. I'll address the top, and I'll see you in the next one.